The straight and narrow is no place for investors. Diversification is the key to successful long-term investing. When you come to a fork in the road and you have a decision between two stocks, go both ways. Buy some shares of each. Fill your portfolio with as broad a selection of stocks as you can afford. Some investors think they're diversified when they own 5 or 6 stocks. But if some of those stocks are in the same industry group, that's not diversification. To be truly diversified, a portfolio needs several elements. Stocks from several different industry groups, such as foods, medical products, telecommunications, retail, manufacturing, chemicals, consumer goods, financial services, and computer goods. Don't overstock your portfolio with the latest fad stocks. Large blue chips as well as up-and-coming emerging growth stocks. International mutual funds that help spread your assets to stock markets around the world. According to a long line of studies, the best approach to consistent, long-term performance is to spread your assets around. Next time you hit a fork in the road, go both ways. About market timing. There is a perception among some inexperienced investors that the best days in the market are past, that stocks have gone as high as they're going to go, and that it's too late to buy into the market. Although there certainly is some truth to the notion that the best time to buy anything was last year, that doesn't mean that prices won't go even higher next year. In fact, stocks tend to go up most years, so the price you'd pay for a stock today is likely to be higher than it would have been a year ago, which also means, of course, that by next year, today's prices will probably look like a bargain. That's why smart investors continue to add to their holdings year in and year out. Those who are new to the market have a hard time grasping the concept of an ever-rising market. They are under the notion that the law of gravity should have some bearing on stock prices. What goes up must come down, right? And they're confounded as to how the market can continue to defy the laws of nature. While the market goes through its share of ups and downs, generally speaking, the trend is ever upward. But there's nothing magical about it. The stock market's steady growth makes perfect sense. The price of a company's stock tends to go up as the value of the company goes up. A company's value is determined by a range of factors, such as its earnings, revenue, assets, cash position, debt-to-equity ratio, and other financial considerations. Most corporate managers devote their efforts to increasing the value of their company by increasing sales, earnings, and assets. The greater their sales, earnings, and assets, the more valuable the company becomes. That growing value is reflected in the rising price of its stock. The company is worth more, therefore the stock of the company is worth more. There's nothing magical or gravity-defying about it. Stock prices rise because the value of the companies they represent rises. So if you missed this year's big run-up, don't despair. Put your money in the market and wait. Otherwise, you may be kicking yourself next year for missing out on such a great buying opportunity this year. Although many investors try to time the market, none do it successfully with any consistency. In fact, the stock funds that tend to do the best over the long term are the ones that remain almost fully invested in stocks all the time. Those fund managers have learned the futility of trying to figure out when the market is going to rise and fall. Here's an all too common scenario of a novice investor. He or she buys 6 stocks. 3 go up, 3 go down. They sell out the winners for a nice profit and hold on to the losers in hopes that they rebound. With the profits from the winners, they pay the taxes and buy four more stocks. Two go up, two go down. They again sell the winners, keep the losers, and repeat the process once more. What they ultimately end up with is a portfolio of losers. They sold all the good stocks, paying taxes on the gains, and held on to the losers. If they had done the opposite, they would have a portfolio of winners and a nice tax break from dumping the losers. Your ultimate goal should be to accumulate a portfolio of great stocks. You don't do that by selling out of your winners. Cut your losses and let your winners run. Never buy a stock on the way down. Never sell on the way up. Momentum is one of the strongest forces of the stock market. When stocks catch fire, they can climb far beyond reasonable levels. And when they drop, they can also drop beyond all common sense or reasonable expectations. When you sell a stock on the way up, hoping to time your move at the peak, you risk missing out on even greater growth. Imagine investors who sold out of Walmart in 1969 after a nice run-up. If they had held on to the stock instead, $1,000 worth of Walmart stock would have grown to more than $1 million 25 years later. When you try to time a buy on the way down, hoping to catch it at the bottom before it turns around, you could be in for a long, unexpected drop. As Peter Lynch once put it, it's always darkest before pitch black. In the early 1990s, I followed a stock as it dropped from 35 to 13 a share, where I finally bought it, believing it had reached the bottom. It hadn't. It continued to drop to 10, 5, 3, 1, and into bankruptcy. When you buy a fallen stock, try to be sure the stock has hit the bottom and has shown some evidence of a turnaround. Then ride the stock's upward momentum as long as the trend remains positive. As they say on Wall Street, don't fight the tape.